There's no need to make investing harder than it should be, so I figured I would make it easy for y'all by giving y'all a roadmap in my first ever tier list video. Now, I've gathered a handful of popular dividend growth stocks, which is the main theme of my portfolio, and I just wanted to rank how I personally think they'll do in 2026. And all of these have a track record of at least being solid, so any one of these stocks may not be a terrible investment, but all of that to say, it's probably going to be a little bit skewed to the upside. But let's just get right into it. So starting off strong, we have Visa. They have amazing growth all around per usual. They're in the financial sector, which is just Tom Lee's pick for one of the greatest sectors for 2026. He thinks they're going to completely outperform. I know he mostly chooses banks, but I think this will still benefit from that a little bit. They did issue more shares recently, and they're not growing as fast as Mastercard. So I'm going to put them a little bit lower than Mastercard, but I still think they're going to be a solid A tier. Moving over to Mastercard, it's the same story as Visa. The growth all around is amazing. And Joseph Carlson actually made a great point about this in one of his Patreon episodes. People like friction in the payment process, as crazy as that sounds. But a lot of people think stablecoins are going to just completely eat away Mastercard's moat. But with stablecoins, when you buy something, it's done right then and there. Whereas when you have a credit card, you buy something, you get your points or your travel miles, whatever, and then you have 30 days to pay it off. And on top of all of that, it's not your money in the first place. So if something gets messed up, you can just dispute it with them and it's their problem. They have a way higher return on capital employed and return on invested capital than Visa. And despite this whole 10% cap thing that everyone's been worrying about, that literally doesn't even affect them. This is just going straight to S tier for me. I think this is going to be a great year for Mastercard. So moving away from these powerhouses, we get to Pepsi. And I won't lie to y'all, it's not looking good for Pepsi. Their income has been relatively flat since 2023. Their payout ratio for their dividend is above 100%, so they're going to have to start worrying about that pretty soon. It's a mature company with slow growth, so even if there was a lot of things going for it, I still don't think it would do that great relative to a lot of these other stocks in 2026. I don't think their death is imminent. I think they will continue to chug along, but compared to Coke, I really don't think they'll do that well. This is just going to go straight to C tier. Honestly, I might even move it to D tier. Moving over to Coke, their largest competitor, it's honestly a very similar story to Pepsi in that it's a mature company with slow growth, but I think it'll continue to chug along. The top and bottom lines are growing faster than Pepsi, and it's also at the lower end of its 5-year historic PE ratio. I'm going to put this one in B tier. Next, we got Home Depot. Now, this is going to be a little bit of foreshadowing, but I think all construction companies are going to do at least decent with the recent rate cuts. But with that being said, this is, again, a mature, slow-growing company. They are partnered with Google, but I really don't see that adding much value to their business, and I honestly don't even know what that's supposed to accomplish. I've talked about this before, but Alex Rose has seen firsthand the rates that his trucking company charges to haul their products versus Lowe's, which leads to unnecessary spending. I'm going to put this one in B tier above Coke if I can figure out how. Next is Lowe's. So I think rate cuts again are going to lead to solid growth, and that's a theme that I have with a lot of these stocks. I think rate cuts are helping propel them forward, but they just made an acquisition, and I think that is a lot more accretive than a Google partnership, at least in this business. And from a total return perspective, Lowe's has been outperforming Home Depot for years, so I'm going to go B tier again with this one. I'm going to put it right above Home Depot. Moving on, we get to Fastenal. Now, technically they are an industrial, but they do benefit from increased construction, which again, I think will happen because of these rate cuts. And I've actually never talked about them on the channel before, but they are a pretty popular stock in the dividend growth community. They have a healthy amount of debt that they can pay off quickly if they need to. They see fairly consistent double-digit growth across the board with really high return on their capital, and their margins have been slowly increasing since the 80s. I looked at a few valuation metrics. I don't think this company is undervalued, but I definitely don't think they're overvalued as well. And I wouldn't be surprised to see them do pretty solid this year. I'm going to go low A tier. Now we're getting into some growth monsters with Taiwan Semiconductor. This company is going to do good. Literally, what does anyone else expect? It's been growing its top and bottom lines 30 to 40% a year. It's in the biggest industry everyone is talking about right now. It's drowning in cash. So if it needs to pivot and maneuver certain situations, it's able to do so. From a valuation perspective, I wouldn't exactly call them cheap, but they just partnered with Etched, and they're also looking to expand significantly into Arizona. I think both of these could be tailwinds, and again, with all this growth in not only the stock and the industry, I really don't mind a high PE. Literally, what chip company has a low one? Taiwan Semiconductors, I'm going to put in A tier. Let's move on to Google. Despite only owning 2 shares, I freaking love this company, and I think they're one of the greatest companies ever. I just wish they paid more dividends. But if we look at their numbers, they look amazing across the board. Waymo is blowing its competitors out of the water. They're drowning in cash. The only thing that I think holds them back this year from providing monstrous returns is that I think a lot of those returns were realized recently in this most recent rally. I'm up over like 90%, but I think Google will continue to crush it. It's going towards the top of A tier. Now we get to Apple. I'm really not a big fan of Apple, but it looks like they finally have some stuff going for them. They're partnering with Gemini to help make Siri and Apple Intelligence an actually good product, and they're attempting to make their own AI chips. They've seen solid margin expansion. Their return on capital employed and return on invested capital are extremely high. They've been buying back a phenomenal amount of shares. Their Mag 7 tech stock that still has managed to outperform the S&P despite flat revenue for 3 years. I don't think it's a bad idea to put this in A tier. Next, we have Costco. Greatest business model of all time. I love this stock, and as much as it pains me to say this, I'm not sure if they'll do that well in 2026. Yes, we did see some multiple expansion, and that shot Costco up over 11% year to date. But I've ran a DCF model myself, and to achieve a 15% return, we would need the PE ratio to hit 60. Costco is still an amazing company that is continuing to crush it like always, and I understand that investors are willing to pay a premium for more certainty, but I think the valuation has just gotten almost too high, and I think this will be another year for Costco to move down or sideways. And as much as this freaking pains me, I think I have to put Costco in C tier. Although I think it's going to do way better than Pepsi. So we're moving Pepsi to D tier. Next up is Caterpillar. Anytime I see construction, this is the only company I see. A lot of the same thesis as Home Depot and Lowe's, and they have a partnership with NVIDIA. I honestly don't know what that's supposed to accomplish, but that could also be considered a tailwind, along with the fact that we will most likely need to continue building out a lot of data centers very quickly. They are at a high PE ratio compared to their history, but I still think they have the growth and catalyst to support some decent growth, at least over the companies like Lowe's and Home Depot. I'm going to put this in B tier above both of those. Next up, we have another one of my favorite companies, ASML. I have a bias because this is my biggest position, but I keep saying this is the picks and shovels of the AI race. They don't have the prettiest income graphs due to the nature of their business, but they've slowly been increasing their margins, and Intel just installed the first high numerical aperture extreme ultraviolet lithography machine. That was a big word, but it's a huge tailwind for this company. If you're unfamiliar, their machine allows us to make microscopic details in computer chips, and they were already doing amazing. Now they basically just released the next gen version of their machine, so this will likely raise margins even more and increase top and bottom lines pretty dramatically. And aside from all of this AI, the AI industry is still climbing fast, and it has just been rapid growth across the board. I'm up 16% on this company year to date alone. I think this should go straight to S tier. This website is so freaking glitchy, but moving on to GE Aerospace. If you're like me, this probably popped up on your radar when you first heard that Chris Hone has 27% of his multi-billion-dollar portfolio allocated to this company. I was honestly confused for a while because I've seen GE everywhere from lights to dishwashers, and now all of a sudden they make plane engines. I honestly had no idea, and I knew nothing about this company until Joseph Carlson released a deep dive about it for his Patreon. While they are up 78% over the past year, I think a lot of people are still either confused or don't entirely know what's going on. And I think as more time passes, more people will jump on the GE train, and it'll be another good year for this company. They make aircraft engines, and the moat is so incredibly wide for this because of a few different reasons. The first biggest reason is that it takes an immense amount of money, and even multi-million dollar businesses have almost gone bankrupt trying to compete. They have a few similarities to ASML, where once you get past the first hurdle of money, then you have to actually figure out how to make it. And if you want to make an engine for a commercial aircraft, good freaking luck. There's so much regulatory scrutiny in order to make planes safer that half the time, if a company does figure out how to make these engines, they don't pass inspection, and that adds even more to their moat. They also have install-based contracts like ASML, where they do have to do maintenance later on, so that also adds some recurring revenue. And all of this combined with the war/defense budget stuff going on with the US government, I think that'll be a strong catalyst for this company for 2026. This is going straight to S tier right under ASML. Next is Intuit. This is a stock I haven't talked about in a while, but I've been very bullish on. They have some of the smoothest income graphs I've ever seen, and due to the nature of their business, they will always have customers. Despite this, it's been selling off because investors think AI is going to disrupt their business model, which I just don't believe. I actually think AI will help them by making the process even more efficient, and we're already seeing this. They have a $100 million deal with OpenAI, and they've already begun to implement AI into their platforms. Their QuickBooks AI has allowed customers to save time and even improve their cash flow predictability. Aside from this, according to their investor presentation, they only make up 6% of their total $300 billion addressable market, so they have a long runway for growth, and I think rate cuts will cause even more businesses to start popping up, which will only help them. What's tricky with ranking this company is we have to see the story change before the price goes anywhere, but I think it'll continue to grow. And when we see their earnings continue to increase for Q1 of this year, I think that's when a lot of investors will start to change their stance and start to re-rate this company. I ran DCF models, and with all of the things that this company has in its favor, I think it should go in S tier. Healthcare lagged the market in 2025, and I really think the theme across the board is for all healthcare stocks to do well in 2026. So I'm already leaning into one of the higher tiers for Novo Nordisk, but let's talk about this a bit more. 2025 wasn't a good year for them, but they still grew top lines and free cash flow. They're also maintaining good return on capital metrics and good margins. They're actively building in the US, which I think could help improve margins even more and build better relations here. They won the oral pill race with Wegovy. The UK just approved a triple strength Wegovy dose, which will obviously be more effective in regards to weight loss, but will also drive their per patient revenue up. They still have a long runway with the obesity market expecting to grow significantly. I think this company will bounce back a lot in 2026, and it deserves A tier. I think we could safely put it above Apple and maybe even Visa, but I'm just going to place it here for now. I think the company is due for a very fast rebound. Next up, we got Salesforce. This stock has gotten beaten down a lot. It's down almost 30% over the past year because revenue has slowed down, and a lot of people think AI will disrupt this company. However, even though revenue has slowed down to an 8% rate, which still isn't even that bad, earnings per share has averaged over 30% growth over the past 2 years. Free cash flow has grown at a rapid pace, and their margins are growing quickly. Their total performance obligations is growing at a healthy double-digit rate, and their AI platform Agentforce is also growing at a consistent, healthy rate. This company is deeply entrenched in the businesses they work with, and again, with rate cuts, I think we'll see even more businesses popping up. I have seen people in comment sections, whether they're lying or not, say that they work there and it's depressing and not a good environment. Although Glassdoor has it rated at 4.1 stars, so I don't even know what to think. This one seems a bit difficult to categorize, but I think the sentiment is so negative that even if their numbers continue to be good, I don't think the stock price will follow that well, at least in 2026. I'm going to put this one in B tier. Now we get to one of my favorite companies. I feel like I've said this a lot this video, but this one has treated me so well. I'm up over 190%, which is just ridiculous. Because I've talked about them so much on my channel, I won't go into specifics, but they've grown their metrics across the board at an extremely fast speed. Return on capital employed is rising, margins are rising quick, and they have way more cash than debt. I will say the PE ratio on this has gotten high, but they do have recurring revenue from maintenance contracts, so some of this can be expected, but they still have so many catalysts for growth. They're an HVAC company, and I think they'll be able to ride the AI wave because data centers get immensely hot, but they're also working on semiconductor plants as well. This company is up 1,881% over the past 5 years, and as much as it stings because I want more shares, I think that it's going to continue. I'm putting this straight into S tier. Man, I thought the tier list was already hard enough, but deciding where specifically the stocks go in each tier is also a challenge, probably even more so, but I do think we could see Comfort Systems do better than Mastercard and Intuit. But moving on to Meta, another Mag 7 stock, of course it's going to do well. Dividendology just made a video talking about them because Tom Lee is bullish on the Mag 7, and Meta has one of the lowest PEs and highest growth rates compared to their peers. They're cutting metaverse spending, which investors are liking because this was basically seen as a black hole for their money. And I've listened to Zuckerberg and I think he's a good leader, and they're continuing to sacrifice now for the future. So I think they'll continue to do good later down the line. But again, they're a Mag 7, so I feel like I just have to put them in A tier. Next up, we got Waste Management. I like this stock, but there's really not much to say about it. They're asleep well at night. They're going to continue to see steady growth and slightly outperform the S&P. You're not really buying Waste Management for growth. You're buying it for safety. I'm just going to put this one in the B tier. Wow, we got another Mag 7. Guess where I'm going to put this one? In all honesty, Microsoft is one of the best businesses in the world, and they're growing their cloud backlog incredibly quickly. They have more cash than debt and growing margins. Goldman Sachs raised their price target, and a Morgan Stanley CIO survey showed that 92% of CIOs plan to adopt Microsoft's generative AI tools, and Azure is still their top cloud choice. Their price has fallen, but I think everyone knows that isn't going to last for long. I love this company. It's got to go in A tier. Now we have UnitedHealth Group, another healthcare stock that's going to rebound in 2026. They've now repriced the majority of their business, which was a big cause of declining revenue. They've launched a rural hospital pilot, whatever that means, but this will cut payment times to rural hospitals throughout 4 separate states, and that will put less strain on these vulnerable hospitals. Not too much else to say with this one. At its core, it's a solid company, and I think the repricing will do most of the heavy lifting, and I think sentiment will improve and drive the stock higher this year. A tier, right below Novo Nordisk. I had a hard time saying some of those words, but let's hope I can get through this one. So next up, we got Broadcom. Semiconductor company in the midst of the AI boom, literally no way it does bad. Also has extreme financial growth across the board with rapidly rising margins. Their acquisition of VMware is proving to be a success. They actually announced a brand new customer, Anthropic, with an $11 billion chip order for the second half of 2026. I was reading the Morningstar equity analysis, and their price target as of December 2025 is $480, and they also expect their return on invested capital to hit 50% by 2030. Broadcom is a bit of a toxic company, but they claim that more than 99% of all internet traffic has gone through at least one Broadcom chip. And I think with all the catalysts and this being the right company at the right time, it isn't a stretch to put this one into S tier. Originally, I wanted to put Broadcom between Mastercard and Intuit, but honestly, I think it could outperform Mastercard and Intuit. I think that's a good spot to put it. But moving on to Lockheed Martin, with all this stuff going on in the US, I had to put this one on the list. I'm honestly kind of late. This stock is up over 16% year to date. The financial metrics for this stock aren't the greatest, but they have been growing revenue at a steady rate, and free cash flow has grown very quickly. The largest catalyst for this stock is war, and again, look what's been going on in the US. I really don't have much to say about this stock, but if the US continues on this path, which I think they will, I believe this will continue to outperform in 2026, so I'm giving this one a low A tier. That pretty much makes up my list for 2026. Let me know what I missed. Now, remember the whole voting machine versus weighing machine. It's very hard to predict exactly which stocks will move in a short time and by how much. But I think this is a pretty good estimate. And even over the longer term, I think this, for the most part, still holds up. And again, over the long term, I think the majority of these companies are still going to do well. This is just what I think will go on in 2026. I hope you got something out of this video. If you did, consider leaving a comment, consider subscribing. I would really appreciate it. Good luck on your investing journey.